The one thing that everyone wants are low interest rates. Even the President of the United States, just like everyone else, is waiting for Joe Powell to finally say that this time we are going to lower down interest rates. But in the last meeting of the Fed, Jay Powell made it clear we are going to keep the rates the way they are. And that's what I told you in one of the previous videos just before the Fed meeting took place. There are so many reasons to believe that maybe throughout the entire year of 2025, interest rates will be at around 4.5%. Now, low interest rates make investments so easy, so great. Remember back in 2020, the stock market was growing, crypto was booming, real estate was going all over the place. It doesn't matter where you invested your money, everything was growing so tremendously, and everybody wants that period to come back. But it seems like, especially from the last meeting of the Fed, it's not happening, at least in the foreseeable future. And America is entering a new era of high interest rates. Interest rates most likely are not going to go below 3 to 4%, at least in the next 5 to 10 years. And as the situation with the national debt deteriorates, situation will get much worse than that. So let's break down what exactly the chairman of the Fed said. What is the state of the economy, and why are we not going to have any kind of low interest rates in the foreseeable future? When it comes to interest rates, most likely they're going to stay between 4 to 4.5% for the entire year. At least that's the projection. Until there is going to be any kind of clarity, they will not be lowered down. And the best case scenario is 4%. Next year, the expectations are a bit better than that. They will be between 3.5 to 4%. But that's far from the 1 or 2% that everybody wants to see. In the long run, interest rates are expected to be anything between 3 to 4%. And that estimation has been made without considering what might happen in the next 2 to 3 weeks. Will the big beautiful bill is going to be passed? Will the war with Iran is going to happen? All of these are massive changes in the global geopolitics that will have profound impact on prices in the United States, which might force the Fed to reconsider their expectations about the future. The economy is in a very solid position because unemployment is very low. It's a little over 2%, but that's actually great considering the fact that we have interest rates of anything between 4% to 4.5%. However, in the long run, GDP is not going to grow that much. At least for 2025, the expectations are 1.4%. And that makes sense because the United States right now is in a very weird situation. It does not have clear trade agreements with other countries, even with its closest neighbors. It doesn't know where the economy is going to be a few years from now. And the GDP expectations for next year will be around 1.6%. So forget the period of the United States growing at 2.5%. You know, they are making an argument that we're going to cut taxes so much that the economy will grow at 2.5 to 3%. That's not happening, at least according to the Fed. And in the long run, the expectations are even below 2%, which means that the national debt from now onwards will be growing significantly faster than the GDP, and the government will not have enough revenues to sustain that debt. The Fed has done a great job bringing inflation to around 2.4%, but it's not going to hit 2% in the next 2 years, and it will be above 2%. In the long run, the expectations are 2%, of course, but nonetheless, unless we bring that inflation to around 2% and the Fed will have a strong grip over that inflation, forget about lowering down interest rates. And according to the Fed itself, if they're not going to bring it down by 2027 and 2028, then forget the low interest rates of below 3%. The Fed's main goal, without price stability, we cannot achieve maximum employment. The job of the Fed is to make sure that there is full employment in the United States, and the only way you can do that is when you have price stability, because if there is no price stability, businesses do not know how to plan. Imagine for a moment a situation where prices are rising too fast. Then suddenly people will start demanding higher wages. If you're making $50,000 and if it's not enough to pay for the basic bills, you're going to ask for a higher wage. And if it's not going to be provided for you, you will start looking for a different job that is going to provide you with that wage that will pay your basic necessities at least. Then businesses will take that cost and they'll pass it down to their consumers. And that means higher prices for consumers as well. And it turns into this never-ending cycle of prices consistently rising and rising and rising. So you as a business, what are you going to do next? You will suddenly start cutting costs, or you will start cutting your jobs because you don't know where the prices are going to be. You started this business because you wanted to make money. This business is not going to survive if it's not profitable. And if prices are rising so fast, if your employees are consistently asking for higher wages, how are you supposed to do this business? Unstable prices create the biggest problem for businesses, which is uncertainty. The only way you can do a business is when there is certainty, especially when it comes to prices. If you buy something from one country and by the time you get it to a different country and prices rise so much, can you do business? And that's why if you look at the map right now and find out the countries with high inflation, you see that businesses are not doing great over there. You see that businesses, other corporations are avoiding that country because how are they supposed to get into that country, build their global supply chains across the globe when they don't know what is going to be the final price, when they don't know how much people will pay at the end of the day for that? And that creates less investments. Less investments means that less jobs will be created. And that brings us to the main problem that the Fed is trying to create: maximum employment in the country. However, Trump's entire presidency is uncertainty. Let's call it strategic ambiguity. And nobody knows for a fact what Donald Trump is going to do next. I think even he himself is not sure what he's going to do next. He will take his final decision at the last moment. And I think he's doing that purposely. It's not me trying to criticize him, but it's his way of doing politics. It's his way of presenting and projecting power, because nobody around him knows for a fact what he's going to do. So nobody can control him. And he's the final person who takes this decision. But that strategic ambiguity is creating uncertainty, because what is opposite of ambiguity? You have ambiguity, and the opposite of that is certainty. You don't have certainty, then how the Fed's supposed to make any kind of decisions? Take trade, for example. That's what the Fed has emphasized in the last meeting. The United States so far has signed a trade deal with the United Kingdom, and that trade deal is not even certain whether it's going to last for a long time. Secondly, there are negotiations with China, and they came to an agreement of basic things when it comes to trade with China. But again, that trade agreement will last for the next 6 months. What will happen next? Will they come to the final decision? How that trade deal is going to look like? How will that impact prices? China is one of the major trading partners of the United States. A lot of US companies depend on China. There's so many questions. So you are the chairman of the Fed. How are you supposed to make these projections when you have no idea or whatsoever what the president will do at the end of the day? Secondly, immigration. The number of immigrants in the country has a profound impact on wages. If you have a lot of illegal immigrants who are going to take really cheap jobs, then a lot of companies can lower down their cost. Even legal immigrations, it's the exact same thing. Immigrants often ask for lower wages than the native people. It doesn't matter which country we are talking about, even the United States, which means that if we don't have a clear understanding of the number of immigrants that will come to the US, then we don't have a clear understanding how the cost will look like in the foreseeable future. Whether it will be high or low, it doesn't matter. We need to have some kind of certainty about it. Thirdly, fiscal policy. It's basically the government spending. The government raises money from taxes or debt and then starts spending that money. And nobody in the economy spends as much as the government. The government is the biggest spender. They spend on the military, they pay Social Security, Medicare, and all those dollars circulate within the entire economy and create this economic growth. But any kind of spending is also inflationary. More money being spent, higher inflation. The demand for any goods increases their prices. Now, how much will the government spend? That's a good question. That's the question that the Fed is most likely or certainly asking themselves. And there is two problems with that. First of all, there is the big, beautiful bill. This bill is supposed to cut taxes and increase spending. An extra $150 billion for the military, increased tax cuts. So we don't know for a fact how much the government is going to spend. On one side, they're trying to cut taxes, which is going to cut the government's revenue. On the other side, they're increasing expenses. So where are these extra expenses are going to come from? Obviously, there is one way, that's debt. And if you cannot raise that money from the public debt, then you will raise it from the Federal Reserve. Secondly, there's a lot of backlash when it comes around that big, beautiful bill. What is going to be the final bill? How is it going to look like? Will the Senate pass it on the 4th of July? And if they're not going to pass it, what kind of modification is going to happen to it? For example, right now, they made the raise in debt ceiling part of the big, beautiful bill. Will they actually separate it if it's not going to pass the Senate? There's so many questions that leaves the Federal Reserve very uncertain, and they cannot do accurate projections about it. Secondly, the war in Middle East. Will the United States be involved in this war? Now, I'm kind of confident that nobody knows for a fact. I think even Trump is kind of thinking about it, and he will take the decision the last moment. Now, I don't know. That's basically just my understanding of how everything is happening. And that leaves the Fed in a very uncertain situation because, let's be honest, we don't have to invent the wheel. All we have to do is to take a look at how much previous wars costed the United States. And it's in trillions of dollars. Because when you are going into a war and you're invading another country, you're sending troops, you have to pay those people. It's going to cost like billions of dollars. But if we are going to be honest, it's going to cost trillions of dollars. And the government will have to borrow that money from somewhere. And that's extra government spending. So the Fed is not sure what's going to happen. Jay Powell made it clear that the focus right now is to bring down the balance sheet of the Fed because we have skyrocketed the balance sheet from $4 trillion up to $8 trillion back during the pandemic. And if the United States will be involved into this war, then this balance sheet is going to grow, since there is a lot of doubt how much the government can actually raise from the public. Let me give you an example. In the last just a few months ago, when there was the Liberation Day, everybody thought that there is going to be a lot of capital inflow to the United States, which will lower down the yields. But the absolute opposite happened. The yields did not go down. In fact, the opposite has happened and the yields has increased. And now that puts the Fed in a very jeopardizing situation where the Fed is like, if a war will happen with Iran, what will happen to the yields? And that means that there is a very high probability that it will be funded by the Fed. And funding by the Fed is literally the definition of growing the balance sheet of the Fed. And that leaves the Fed with the only second option to control inflation, which is keeping the interest rates as high as possible so that spending does not get out of control. And that creates another problem that complicates the entire investing. When you have very low interest rates, it's very easy to invest. Everything is growing. It doesn't matter. So you have companies in the stock market, they can literally strengthen their balance sheets by borrowing money, since the cost of borrowing money is very cheap, since the cost of capital is very cheap. So when we do valuations, we look at their financial statements and we see they have so much cash. They're very liquid. They can survive for years to come. The moment we raise the interest rates, then the cost of capital goes up, and we can literally mathematically predict when this company is going to get out of business. And that's why in 2022, when the Fed hiked the interest rates, we had so many bankruptcies. Just go to Google, type down how many companies went bankrupt in 2022, and you will see tech companies, pharmaceutical companies, cryptos that entirely were eliminated. Which is why from now onwards, if these two things happen, at least that's what the projections the Fed are right now, that means that the United States is entering a new era of high interest rates, which complicates the entire investing. You no longer can simply just close your eyes and throw your money into some kind of stocks and they're going to rise. You have to do your analysis. You need to be able or to develop a skill of distinguishing a good stock from a bad stock. You have to find the intrinsic value of the stock to know for a fact that this is the true value. So if this is the price, it's maybe undervalued, maybe it's overvalued, maybe it's fairly valued. And that's from now onwards. I think the separation or the difference or the wealth gap is going to keep rising from now onwards, because we have a bunch of people, or the most Americans who buy stocks, they have no idea what they're buying. They're gambling, and that's what they are saying. On the other side, we have really great professional investors who take really great professional investing decisions, and their portfolios are going to rise from now onwards. But the vast majority of Americans who know not much about investing, they will see their wealth go down over time. And that's why if you're interested to master investing and master the skills that will help you to actually find really great stocks in the market, then make sure to check our academy. You can find it out by checking the first link in the description of this video. Thanks for watching, and I will see you in the next one.